What do all these famous men have in common? What do they have that you don't have? Well, other than fame, celebrity, and hordes of crazy obsessed fans, that is. All these men have lost unimaginably large sums of money by making some truly terrible investment decisions. Luckily for you, you have me, and today I'm going to help you answer one of the most perplexing questions in the history of human existence. What is the safest portfolio? Well, the safest medium risk portfolio, that is. So finish that bowl of Wheaties and put your thinking caps on, because you're about to learn how you can create a lot of wealth without having to worry about losing it all overnight in a stock market crash.
I'd like to buy 500 shares of Animotion Incorporated.
Okay. Now, before I execute this order, are you sure you understand the risks of stock ownership?
Absolutely.
We're in the money. We're in the money.
You heard the monkey. Make the trade.
Portfolios are typically grouped into one of four categories: low, medium, high, and very high risk. Today we're going to go to the middle of the road and investigate which medium risk portfolio is the safest. In this video, we're going to compare Ray Dalio's famous all-weather portfolio against Harry Browne's legendary permanent portfolio to try to figure out which, if either, of these portfolios is better. First up, we have Ray Dalio's all-weather portfolio. This is a portfolio purpose-built to perform well in any market condition. It uses a strategy called risk parity, which just means that instead of deciding how much of your money goes into what asset class based on a percentage, you decide how much money goes into each asset class based on how risky that asset class actually is. This portfolio is 30% stocks, 40% long-term U.S. Treasuries, 15% intermediate-term Treasuries, 7.5% commodities, and 7.5% gold. That 55% bond allocation seems unreasonably high at first glance, but you need to understand that stocks are 3 times as risky as bonds, and this portfolio was specifically designed to perform well in any market condition. Next up, we have Harry Browne's permanent portfolio. The permanent portfolio is built to handle 4 specific economic conditions: expansion, recession, inflation, and deflation. This portfolio consists of 4 asset classes: stocks, long-term bonds, short-term bonds, and gold, with each asset class having an equal weighting of 25%. The philosophy here is that when the economy is expanding, stocks and bonds do well. During a recession, short-term bonds and cash do well. During inflation, gold does well, and during deflation, long-term bonds and cash perform the best. So how do these portfolios stack up in terms of risk? Well, it turns out they're pretty close to each other. Standard deviation over the last 13 years is around 7%, which just means that each portfolio could move up or down by 7% or so in any given year. The Sharpe ratio gives a slight edge to the all-weather, but that could be measurement error. The last time I investigated these portfolios, the standard deviation was around 5%. So both of these portfolios have increased slightly in terms of volatility, but they're still way below the risk of a stock-heavy portfolio. The Dalio all-weather portfolio got a higher overall return, but just barely. Both portfolios return an average of just over 7% annually, so this means that this portfolio is doubling in value about every 10 years or so. The worst year both portfolios had was in 2015. The all-weather lost 3.6%, and the permanent portfolio lost 3%. The worst drawdown either portfolio suffered was around 12%, which is pretty damn great if you ask me. Before we can reach a conclusion, let's take a look at some metrics. The U.S. market correlation is less than 0.5%, which is ideal. Both portfolios returned about 5% over the risk-free return, which is also pretty good. The safe withdrawal rate is 10 and 11% respectively. The perpetual rate is about 5%, so we could withdraw about $50,000 per year from $1 million portfolio at the beginning of each year and not worry about the previous year's performance and still have not drawn down on the principal balance. Okay, so after looking at all the data, what do we think? Who wins today's challenge of the safest medium risk portfolio? It's a hard choice, but if it were me, I'd choose Ray Dalio's all-weather portfolio. I think you can't go wrong with either of these portfolios, whichever you decide is best for you.